Hi, everyone. I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, we're going to talk about an investment overview. All the things that have been happening here in early 2025, maybe look a little backwards on 2024, but mainly I think we want to just deal with what's happening in the short period in 2025. Joining me today is Joel Baker, our Chief Investment Strategist. Welcome, Joel.
Hello, Mike.
So, Joel, we got to talk tariffs. We had a dedicated episode when the craziness all started earlier in January. So let's start there. And I'd love to get your perspective on this. What are your thoughts here on
Sure, Mike.
Trump tariffs?
I say this jokingly, but let's start with an easy one. How's that for
Yeah.
But no, it's very serious. I think last time you and I chatted, Mike, it was more a context of tariff threats and what that might look like. And I think we've all come to realization that the threats are real here. It's just a matter of what do they look like when they become imposed, and vice versa. How do we stick handle, to use that sports analogy, around that in terms of strategy? So that's probably news since we met last. I'm like everyone else and sort of read the paper and think what happened last night as far as tariff news. But I think it's very real, and Canada has woke up not only just as investors, but as the economy as a whole, in terms of this is real, and how do we unite as a united front and sort of deal with this and strategize around it, and so on and so forth. So that's probably the big thing that stands out since you and I chatted last, Mike, for sure.
Yeah, for sure. I mean, and it is a wake up call for all of us, right? And while it may feel good, arguably good, to boo at hockey games, it doesn't really do anything. And, it's interesting just thinking about interprovincial trade barriers. Here we are talking about tariffs, and yet we have these interprovincial trade barriers, but that's neither here nor there today, but hopefully something that we resolve as a country as we kind of look inwards on ourselves.
Yeah, correct, Mike. And even just to sort of maybe go a little bit deeper than when we spoke last, if you sort of look down at the various sectors, Mike, that will be affected, the big ones are probably no surprise to our audience, but it would be sort of an energy focus for sure. We're not surprised by that one. But sort of drilling down the rest of the subsectors, it'd be more of an industrial flair, I think, that sort of stand out. So anything sort of industrial / energy is probably the two sectors that are subject to the most tariff consideration, or tariff speculation maybe is a better word. So definitely those are the sectors that we want to sort of, protect our core picks, protect our investors' capital, and just be smart about investing in those sectors for sure. So that's probably a little bit more clarity as well, Mike, since we chatted last on the subject, but definitely big numbers. It's not really a one province only effect here. Maybe sort of it's going to affect all the provinces coast to coast, whether it be, everything from steel and aluminum to energy, like I mentioned, even refined petroleum will hit certain provinces pretty deep in the pocketbook, to use that term. So the moral of the exercise, it's not a one province that's a sort of a jeopardy here. It is really coast to coast in terms of the effects on Canada and the economy in Canada.
For sure, we definitely trade north-south. There's no doubt about that, versus east-west. So put the tariffs in some historical context. If some of the numbers that Trump is throwing out, how does that fit from a historical perspective?
Yeah, looking back at history, Mike, it really is a wow factor in terms of, my look on it anyway, my education on this. I had to sort of go back and refresh my history here. It goes back to, believe it or not, back to the Great Depression, the 1930s, before we saw tariffs this high. And it even sort of drew out the Tariff Act, if you will, in the States. And, if we sort of took some sort of an average, Mike, and looked at tariffs and what they look like as far as, U.S. imposing tariffs on Canadian sectors, some sort of a ballpark average would likely be, say, 4% to maybe double that. So call it the 5, 6, 7% range. And then fast forward to Mr. Trump, it spikes it back up to basically 20%. Mm-hmm. So here we are, sort of, normal environment of, call it 5%. Wham, or a wow factor back to 20, that takes us right back to basically the Great Depression, which is it's a completely different landscape comparing, the economy then to the economy now. But it's the same effect from a tariff perspective. So it really is sort of a wow factor to me when I sort of look at that historical context and the ramifications that it could have here. It's a very real thing that's going to affect all of the various subsectors that we spoke about before, and even spending habits of the consumers. You're starting to hear, people getting a little bit edgy on even traveling to the U.S. So
Right.
kind of drilling down into their own spending habits. So this is a biggie for sure. It definitely is something that, we as Canadians have to sort of pay attention to.
I'd like to say that, sanity prevails. It's a mantra I learned early on in my career. There's always a debate, how long does it take to get to that point? And yet with someone like Trump, I think one thing is certain is the uncertainty. And, that's really all there is to say about him. It's, you think logic and the like, you can't help but think that, sanity should prevail. Our economies are intertwined. You take into account energy and all the good things the three economies, including Mexico, have done. But that's neither here nor there. At the end of the day, we have a significant period of uncertainty. So I guess I put it back to you, this unpredictable nature of someone who's in leadership. What's an investor to do?
I think you're spot on, Mike. If there's one thing that we learned last time when Mr. Trump was in power was simply expect the unexpected. And what I mean by that is we would sort of, be in an environment where we'd pick up the newspaper on any day and think, what the heck did you do last night? It really was that sort of environment. And so again, it was a case where we wouldn't want to really bet any sort of, sector sort of bet, if you will, in terms of a policy or a policy decision, a tariff, if you will. So we're big fans of diversifying, as you know, Mike. We're big fans of being defensive, especially in environments like this. We've been doing a very good job from a marketing perspective to show that we're looking at quality names here and quality at reasonable prices. So I would say the current environment, Mike, is no different than that. Like, we want to buy companies that are going to be here through thick and thin, that are going to withstand any sort of a, turmoil right now in terms of economic kinds of things. So again, there'd be no change to the kinds of companies. There's going to be a little bit of tweaking in terms of economic sectors, and maybe some sectors are more expensive than others. So there's always that little bit of rebalancing among sectors, but we're not going to make any sort of big bet from a policy perspective, whether it be in Canadian politics or U.S. politics. So that's probably the biggie is stay the course, stick to the quality, stick to our sort of big, large cap. The dividend payers is something that we always sort of say. So it's good to get that dividend income in terms of, a little bit of added monies or added returns in a period where the capital share price of the capital might go up and down. So again, that's a biggie for sure in terms of part of the total return in clients' portfolios.
Yeah, and one of the values of our approach, dealing with quality companies, as you say, all the qualities that you talked about in terms of large dividend players and leaders in their various sectors. So let's turn to the U.S. economy, because what's interesting here is, if you take any economics courses and you think, okay, although most of them would agree tariffs usually aren't really the answer, but in a geopolitical sense, sometimes governments will turn to tariffs thinking they're solving a particular challenge. And yet you look at the U.S. economy. Talk to us about the leading economic indicators.
Yeah, that's a great one, Mike. So just to back up, when we spoke last, there was some real gray clouds, I'd say, still in the air. Like, there was no real clear indication of where we were going. Some of the indicators had been improving for sure, but some of them were still sort of hinting towards a potential recession or potential slowdown in economics. And although I would sort of generalize, Mike, the economic indicators are improving. So if we looked at all of the, call it even the top 10 leading indicators, they are sort of on the right trajectory. They're up and to the right, if you will, to use that phrase, but we're still in this slowdown kind of camp, Mike. There's no real crossing of the threshold into good times or expansionary times. So even this week alone, if we look at the last, say, 7 days, we're starting to see some signs of, housing slowdowns. We're seeing the HST holiday off here in Canada. We're seeing inflation kind of spiking up again. So some of the indicators that we thought were even behind us are starting to even flare up again. So the good news is they are improving, Mike, but I would say in no way, shape, or form are we out of the woods yet. Even fast forward to see the effect of some of the tariffs and even some of the slowdowns for tariff threats, we're starting to see some of the indicators that could slide to the wrong way as opposed to slide to the right way. So still that caution in the air, Mike. I wouldn't say we're out of the woods yet as far as that. the worst case scenario could be that, it could cause some countries to go into recession, where they were thinking the actual opposite was happening, where things were improving, the wind was in their sail to kind of come out of those sorts of times, and yet wham, here comes tariffs, which could take them back down. So yeah, it's a very, very confusing time right now as far as leaning on the indicators. You don't want to ignore them. But having said that, through all of these things we've just spoke about in the last few minutes, the markets continue to go up. And so that's why you want to stay in the markets, but yet you want to be careful how you're investing in the markets. I think that's a key takeaway for sure.
So let's talk about then interest rates. And you're starting to talk about economic indicators and what the Fed and Bank of Canada, what their policies may be. What are we looking at here in terms of predictions on the U.S. interest rate?
You can't really look at any of these things, specifically inflation, and not look at interest rates. So one of the things that you mentioned just a few minutes ago is if tariffs do come in, typically that leads to an environment of higher prices, which leads to, inflation, which usually then the bank, to sort of mitigate any sort of effect like that, raises interest rates, which is exactly the opposite of what we've seen over the last, say, year and a half here. So if we look at sort of the consensus thinking as of today, Mike, and I say this as a little bit of a caution because it's an indicator that seems to change every week. It really does. But if we looked at it today, the so-called consensus is the same for both Canada and U.S. And what I mean by that, Mike, is that the so-called consensus thinking is each of the central banks are going to drop interest rates one more time this year. So one more cut, if you will, in 2025. So that's what the markets are leaning towards. It seems to be what's priced into the markets, Mike, to sort of use that analogy, especially in the bond side of things. But I must admit, it really depends on where we go from here. If things do turn a little bit ugly and things get aggressive in tariffs, and heaven forbid we turn into a trade war, which usually doesn't have any sort of good outcome for anybody, I think the interest rate projections of today are out the window, and they have to look at things then and going forward. I say this jokingly, but it's been well documented that even Mr. Trump and Mr. Powell don't see eye to eye. So there's a bit of a clash there in two sort of very key figures. In Canada here, we've got Mr. Carney, entering the political space. He's got a background in sort of a, Bank of Canada perspective. So that'll be interesting as well. So long-winded way to answer your question, Mike. That's what the markets are predicting, but I'm not sure how much emphasis I'd put in that being accurate, given all the moving parts here going on in terms of the tariff threats.
Again, just uncertainty. That's what we're dealing with.
Correct.
At the end of the day. So, let's look at the equity markets, and from a valuation perspective, what are we seeing? Let's maybe talk about the U.S. In particular.
Yeah, the U.S. market's probably the easy one, Mike. So again, it's still being affected by the Mag 7, or even if you call it the top 10 companies, they still are dominant in the American market, no doubt about it. But if you sort of looked at the market as a whole, I would say that the way to generalize that, Mike, is it's trading a little bit above average, above history, if you will. If you look at sort of the main sort of metrics that most investors would look at, we are above the 30-year averages in practically every one except for maybe dividend yields or dividend comparisons. So I wouldn't say head for the exit's expensive, Mike, but I certainly wouldn't say the market's cheap in terms of the American market. It definitely is expensive compared to the rest of the world, and there's even sectors that are expensive to its own historical comparison. So you don't want to not be in the U.S. market, but I think you have to be careful what you buy and how much you pay for certain companies for sure.
And that's a good aspect of our QSECT approach. Even though we're sector-based, we can actually, on a sector-by-sector basis, decide where do we see the best value, whether it's in a particular sector on the Canadian side versus the U.S. side, if the U.S. market starts to get overpriced.
Exactly. So even to put that in context, Mike, because that's a great point. If we look at the U.S. market, it trades at about 21.5 times. So let's just call it 22 to use a round number. In Canada, that number is more like 15.5. So again, call it 16. So it's a difference of, 5 or 6, percentage points in terms of that PE ratio. Drilling down, though, you hit a great point. A lot of the companies that we buy in terms of these quality companies are such big, strong companies that one could argue they're multinationals anyway. So it's not like we're buying just the U.S. market. You're buying a company that does a lot of their business outside the U.S. It's just that their head office is domiciled in the U.S. So we call it a U.S. equity. So I think that's a benefit of buying the companies that we buy, the big, strong quality companies. One could argue they're actual global companies, even though like something like a Microsoft, and I'm just using that as an example, does so much business outside the States compared to within the States. So I think that's an added benefit for sure to buying these kinds of companies.
Good point. So let's look overall from a considerations perspective, let's talk about maybe the positives first in terms of overall what we're seeing, and then maybe the negatives. And
yeah, the big
try and summarize.
Yeah, for sure, Mike. That's a great question. The big one for sure is to take a step back, looking at the companies themselves. A positive would be the fact they're financially strong. So we're looking at the earnings right now, Mike, and as of about last week, this would be as of Thursday, I guess. Almost 70% of the companies had reported for the quarter. And if we sort of drill down, about 3/4 or 77% of them are beating estimates by about 7%. So I know that's a lot of sevens and a lot of beats, but at the end of the day, they're beating their consensus estimates fairly strong, and they're above their 10-year averages. So that's good news for the stock market. If we sort of look back and compare it to a year ago, they're up about 16%, which is a very strong number. Again, higher than longer term averages. To counter that though, the market's been strong. So one could argue, even though the earnings are up 16%, the market's up a little bit more than that. So it should be sort of one in tandem to the other. But probably two things that jump out at our team, Mike. One is that if we look forward, the consensus estimates is for this year, another 13% as far as earnings increasing. So another strong number as far as, all of the earnings increasing double digits. The other side is we're taking a really close eye on what management teams are saying as far as guidance. And that's very key here in terms of coming up on these uncertain times. Like, what is management seeing as their own companies, and how is the language changing? And again, Mike, it's all over the map. Some really don't see too much in the way of tariff effects. Some of them are pulling their guidance because they simply don't know, which is honorable. I'd rather them say that than tell us numbers that aren't factually right. So the fact that they're not sure and they're pulling their guidance, that's something that's, we have to consider in our research. But it just goes to show how even the management teams don't know how their own companies are doing because of all of the uncertainties. So again, that's something we're starting to sift through. We talked about last time of, a simple gauge in the market is if a company does come out and miss its estimates by even could be something as small as a nickel, it gets punished more than average. And usually when you see that happen, Mike, it is an indicator of valuations being too high or excessive valuations. So we're still seeing that ugly stick coming out as far as investors sell off names that don't hit their consensus numbers. But at the end of the day, the numbers are looking pretty good as far as quarterly earnings and quality of quarterly earnings. So for me, that's definitely a positive. The companies continue to look strong. That earnings growth should support good stock market. There's good stock market returns. Another one that jumps out is the U.S. economy. It continues to look pretty good. So again, even though it's a little bit subject to some of the uncertainties here, it looks resilient. It keeps marching on. The indicators seem to be doing better. Spending's good. So I think that's probably more on the positive side for sure, Mike. The U.S. economy, that is a big important economy in the global scale of things. So that's a vote of confidence, I would say, in that regard. And even we talked about inflation and interest rates, they seem to be stable. And again, that's the big key thing there. As long as they sort of stay where they are, I'm like, that should be good news for the market, not negative news. But if we do see that get thrown into the wind and interest rates do start to reverse the other way, we'll probably have to have another podcast and talk about that and the effects. But generally speaking, it's been sort of stable, if you will. One could argue whether it's one cut or two cuts. That's just a normal market, if you will. But at the end of the day, it's pretty stable with regards to interest rates and inflation. So I think that's a plus for sure. The negative side of things, the other side of your question, Mike, is the big one we're talking about, tariffs. There's so much uncertainty. We feel a little bit cautious in terms of client conversations, but I think you have to be clear, and we don't know exactly where some things are going to land as far as tariffs or prices of commodities and things like that. But we have to talk about how we're investing around it. Like, what is the strategy based on that sort of a thesis? So lots of good client discussions on that sort of thing, Mike. Drilling down, we're going to see volatility, and that's the key thing that we're talking to with clients. We're going to see some economic sectors be volatile. We're going to see some good names be volatile, even though in some cases it could be unduly sort of speculation on names or speculations on sectors, but we're going to see volatility, no doubt about it. So again, we want to be on top of that and making sure we're making smart decisions, but definitely that would be a negative. Investors are used to strong returns over this last year and a half or 2 years, and we're going to see some volatility in terms of the next little while. So build that into the strategy, build that into the defense, and we're going to have to sort of keep an eye on that. And the last one that I would sort of mention as a counter to what I just said a minute ago, Mike, is inflation. That's something we're going to have to keep an eye on very closely here. As consumers, we're seeing inflation go up. And so we always sort of joke as what not is going up in terms of today's crazy market. And we're going to have to sort of keep an eye on things like that. So whether it be, groceries in the grocery store or gas at the gas station, depending on what it is, or traveling. There's all kinds of examples, Mike, of inflation and what does that look like. But that's something we're going to have to keep an eye on, because that does tie into what we spoke of a few minutes ago, whether it be interest rates or predictions of interest rates or just economic factors or economic indicators in general. So we're going to have to keep an eye on inflation for sure. So.
Right. Yeah. A lot of balance there between the positives and the negatives, and just back to the overall theme in terms of uncertainty. And, no one can really predict how this is all going to shake out at the end of the day. That's the truth. That's the way it is. Other than, again, I'm going to stick to my own personal mantra. Sanity will prevail. I just don't know how long it'll take for us to get there. But Joel, as always, thank you for these insights.
You're welcome, Mike. Anytime.
Folks, if you have any questions, and again, especially during these times, that's why you have the TriCert Financial Group, along with your accounting firm, financial advisors, and your accountant themselves. Don't hesitate to reach out to them, reach out to us, and as always, don't hesitate to reach out to myself. Take care.